Hello, this is Ryan Ray of AAII. We are talking about the latest and greatest from the world of finance and investing for the individual investor. We're broadcasting, and if you're watching this in the archive, we post our upcoming live show schedule on aaii.com/webinars, and AAII members do have access to the full archive of shows. With me is my capable co-host and co-producer, Kyler Worf. Hi, Kyler.
Hi, happy to be here.
Our guests today are Steven Ehrlich, Derek Hageman, John Buckowski, and Charles Ropeblood. Today's show has three topics. First, what are investors' options for investing in cryptocurrency? In the first segment of this episode of the Individual Investor Show, we discuss the novel properties and unique intrinsic values of Bitcoin and other cryptocurrency assets with Forbes Director of Research for Digital Assets, Steven Ehrlich. Next, we reveal the companies passing the greatest number of screening strategies tracked by AAII in our latest First Cut list. Finally, we review new portfolio rule changes for the model shadow stock portfolio and discuss the recent deletions and addition. Plus, our listener mailbag segment, where we answer your questions. Let's get started. Novel properties and unique intrinsic values of Bitcoin and other digital assets are arguments for their inclusion within a modern diversified portfolio. This is the thesis of our next guest's recent article in the AAII Journal. We want to welcome Steven Ehrlich, who is the editor of Forbes Digital Asset and Blockchain Advisor and Director of Research for Digital Assets over there at Forbes. Welcome, Steven.
Thanks for having me. It's a pleasure to be here.
So I think most of us have heard of Bitcoin at this point, but why does its definition as a crypto asset matter?
That's a great question because some of the, like the constructs or features of Bitcoin and other crypto assets that make them a crypto asset are key to really understanding their intrinsic value. So let me kind of break this down for everyone quickly. Bitcoin is what's known as a decentralized crypto asset. It's decentralized because unlike airline miles or Panera points, Starbucks rewards, or any type of loyalty program that many listeners are probably familiar with, there's no one company, entity, or person that is responsible for distributing the assets, keeping track of who owns what, and theoretically could revoke them. And that decentralized nature is very important to sort of the censorship-resistant nature of Bitcoin, which is one key element to its intrinsic value. It's called a crypto asset because it relies on cryptography as opposed to, again, an administrator to help make sure that the network functions as it should. And this means, for one, that through cryptography, people are able to authenticate themselves so that they can prove they own the assets that they say they do. They can spend them, sell them, do whatever they want with them. And then it also uses a form of cryptography to help keep the network secure, add transactions, blocks to the network, and also give it a quality known as Byzantine fault tolerance, which means that the network is able to overcome adversarial actors that are trying to disrupt it. So those two qualities in particular are important to understand why Bitcoin is different than other forms of digital cash, which are really just centralized representations of some sort of fiat dollar. And once you kind of get those, understand those key principles, then you can get to some other elements that help define Bitcoin and other types of decentralized cryptocurrencies' intrinsic value. I mean, for one, the security that comes from this unique setup, the immutable nature of it. And then on top of it, the way Bitcoin in particular was coded, it has a cap of 21 million units that will ever be created. We won't reach that cap until the year 2140, but we're approaching 19 million that have already been created. And because nobody is able to change the code, that number can't be increased. So there can't be like sort of inflationary pressures on Bitcoin because that's hard coded into the system. So there's more I could get into, but those I think those are the main points to understand what is a decentralized cryptocurrency and what makes these types of assets unique.
You mentioned other forms of digital cash. Bitcoin, of course, is not the only crypto asset out there. It seems like every day we hear about new forms of cryptocurrency that are being minted every day. Are there broad categories or distinctions for investors to tell a difference between the different kinds that are available out there?
There are, and as you referenced, there are thousands of cryptocurrencies out there, many of which are completely worthless. But there are a few categories to think about to understand the few dozen or 100 that are really worth paying attention to. One category is known as sort of like the layer one or protocol tokens. Those are Bitcoin, Ether, which is the native token to Ethereum, a different type of platform that's designed to sort of power any type of decentralized application. Think a decentralized version of Dropbox, Uber, Facebook, etc. There's others like Polkadot, Cardano, Algorand, and plenty of Bitcoin forks or variants, and these are layer one tokens, and that means that they're native to a particular blockchain. They can be sent, shared on those blockchains, and most importantly, they're also used to compensate miners or stakers, essentially like the processors that help add transactions to the network and help the network operate. So that's one category. Then there are other tokens known as dApp tokens, and dApp is short for a decentralized application. And these are those applications that might run on top of a blockchain. They are not native to one particular blockchain. Many started on Ethereum, but have now been sort of mirrored on other types of blockchains. They're fungible, so each one is sort of, one can be interchanged for another. And these are more sometimes also referred to as utility tokens. Think of like a ticket to ride on to ride on a ride at a carnival, for instance. Like if you want to purchase a certain amount of decentralized space on the network, you have to pay in this decentralized token, so to speak. So that's a little bit of a difference. The new variant or the new hot thing in crypto is something known as non-fungible tokens, NFTs, which I'm guessing many people listening here have heard of. And NFTs are really kind of, they're sort of a new evolution in how digital assets, crypto assets have evolved. As I said before, dApp tokens and also layer one tokens are fungible, which means that you shouldn't care which Bitcoin you get, which version of any sort of dApp token you get, because they're all identical. NFTs are non-fungible tokens by their very definition. Each have a unique set of characteristics that makes one special. You won't necessarily want to trade one for another. You care which one you get. Excuse me. And so these are used to represent all sorts of new types of assets, digital works of art, music. It can be trading cards, collectibles, and then even sort of like, I guess, like less sexy type of assets such as bills of lading and invoices and medical records and all types of and all different types of assets. So that's one area that's also very, very exciting too. And investors are trying to figure out ways to fit all that into their portfolio and do so in a way that's safe and responsible. And probably the last form of digital asset that I'd like to talk about really quickly are known as stable coins. And unlike Bitcoin, Ether, dApp tokens, NFTs that are very volatile, today, stablecoins, by their very definition, are designed to sort of obviate that. And they do this because they are pegged one-to-one, typically to a fiat asset or gold or something else, either by locking up those dollars in a bank and then issuing coins, or algorithmically through sort of smart contracts and computer programs that automatically adjust supply when needed. So stablecoins don't necessarily fit an investment perspective so much, unless perhaps you're in an emerging market economy that doesn't really have a stable and predictable monetary policy and you're looking to hedge against inflation. But they are a very key element to they're a key liquidity source for the crypto market when it comes to trading. So they're still important to know.
As we say time and again on the show, no one invests in a vacuum, and we all just lived through a pandemic, which was challenging both for the markets and for individuals. Did people turn to cryptocurrency during the pandemic, and how did these kinds of assets perform generally?
Yeah, so I mean, in short, the pandemic kind of turbocharged crypto, Bitcoin, Ether, and a lot of other assets. And I'll just quickly break down sort of what happened from my perspective. So I guess it was on Black Thursday, March 16th, 2020 or so. I mean, Bitcoin, Ether, and the rest of the market, I mean, it basically all correlated to zero, and then people tried to rush into the dollar. I think around that time, Bitcoin was about 8,000. It dropped 50% to, I think, bottom out around like maybe $3,400 or something. But by May, ETH, and plenty of other assets had completely recovered all of those lost gains much sooner than the S&P 500, the NASDAQ 100, stocks 600, basically any index we want to think about. And then it just went on a tear, the assets. I mean, Bitcoin, I think, went up about 600 or 700%. Ether went up like a few thousand%, I believe. I think maybe 14 or 1800%, something massive. And there's a few reasons why this happened. For one, rightfully, in my opinion, central banks ushered in trillions of dollars into the economy to stimulate, to help keep the economy afloat. And that dovetailed very nicely with Bitcoin's sort of core value proposition as a source of scarce digital value. If money becomes cheaper, becomes more available, then people are going to look more towards assets that are scarce and might help preserve wealth. I mean, this also, Bitcoin's narrative has been shifting also from a sort of digital currency to a digital gold. So that fit very well as well, coupled with record low interest rates around the globe. Plus, we really saw institutions for the first time dip their toe in the water. This started around August of last year when Michael Saylor, the CEO of MicroStrategy, a relatively unknown business analytics firm that trades on NASDAQ, bought about $500 million worth of Bitcoin. And everyone at the time thought, well, that's great, but what's this company? We've never heard of them. And then it just set off a firestorm of hedge funds and companies like Square and Tesla putting millions and billions of dollars of Bitcoin on their balance sheet. Other institutional investors started wondering what was going on, and they all sort of thought, well, you know what? There's only going to be 21 million Bitcoin ever created. Most have already been created. So if we're going to try to stake out a position, now is the time. So that led to this cascading effect. The crypto market in general, despite, as I mentioned before, a lot of different use cases for the assets, itself remains highly correlated. So when Bitcoin went up, investors bought Bitcoin, and then they looked at what else was out there. They looked at Ether, they looked at other altcoins that perhaps like outperformed Bitcoin during boom times, and that led to a big surge in the market. One other aspect that I think really helped as well, two more actually really quickly. One, market infrastructure for institutional investors is much better than it was back in 2017 when we saw the first real Bitcoin boom and bust. Like back then, there was no such thing as an institutional custodian. There was no institutional derivative providers out there. CME wasn't offering anything yet, so that helps. And then finally, with Coinbase going public in April, and what at the time was the largest believe still is the largest direct listing in history, Bitcoin topped out at about $64,000. So all those things together really led to the surge. Obviously, as it's been well documented, the market's come down about 50% or so since then. So Bitcoin is still 4 or 5 times higher than it was before all of this happened. I think as we're recording this, it's trading at about 34,000, 35,000, but it's down 50% from where it's at. And I think that also talks a little bit about the volatile nature of this, how early it still is, and some of the other more direct causes for this include Elon Musk, who is sort of the weather vane for Bitcoin, putting out a bunch of tweets worrying about its energy consumption, trying to really tighten the screws, especially on Bitcoin miners, and leading to some current concerns about its stability. Even though, in my opinion, China sort of moving out of the Bitcoin business is probably good for its long-term health. So it's volatile, but that's and I guess a couple of minutes sort of what happened and where we stand today.
Given what you just said about volatility and talking about use cases, your article mentions crypto's potential viability as a source of passive income. Are there general strategies investors should consider if they're looking at cryptocurrency as a way to kind of get at that?
Absolutely. And this is something that I find really interesting and exciting about the space, because as every investor knows, they want to make their money work for them. You don't want to just sitting on the sidelines. But some of the gains that we've seen in crypto assets, it's easy just to put it in your wallet and then just hope it goes up 2, 3, 4, 1,000 times. But now there's actually some ways that you can even earn passive income on those holdings while still staying long on the asset, which can help hedge against short-term reversals. There's a few different strategies for this. One is known as you can lend it to different to borrowers that want to use it for trading or for whatever purpose. There's 2 main ways to do this. One is through centralized lenders, where you can deposit into basically like a centralized company, and they will tell you what interest rate they'll pay you, which is typically somewhere between 2, 4, 5, 6, 8%, which is much higher than what banks are paying these days. And there's certain lockup periods, so on and so forth. And there's various assets, and you can sort of like search around and choose which one you want to look at. A couple of the more well-known centralized lenders in the space include companies like BlockFi, Gemini, Grayscale for starters. Then there's also decentralized sort of DeFi. This whole we haven't even talked about DeFi yet, but DeFi is sort of like a digitized smart contract-based representation of financial services such as lending that exist entirely on blockchains. Most of these are on Ethereum, and they have their own tokens. Some of the biggest ones include decentralized exchanges like Uniswap, and lending protocols like Compound and Aave, where if you have tokens, you can actually deposit them in these protocols and you'll earn fees, as well as receive something known as a governance token from these protocols, which then hopefully will also increase in value for you. So there's a couple of ways that you can earn passive income on your holdings there. The other way is through a process known as staking. And this is sort of there's two main ways that blockchains help add transactions to the network. One is through a process known as proof of work, which is what Bitcoin uses and involve these very expensive computer centers that run thousands and thousands of transactions a second and essentially show their work, for lack of a better term, to add transactions to the network. Obviously, there are some criticisms of proof of work, not only from its carbon footprint, but also the fact that it's slow and its throughput is not very high. I mean, Bitcoin can only handle a few transactions a second. When you think about Visa or MasterCard that handles tens of thousands of transactions a second. Proof of work is an alternative approach where instead of essentially using computer power to process the network, you almost post your holdings as collateral to a protocol, and then you validate transactions. And if you don't act appropriately, you can actually have your collateral seized. So this is it has a lighter carbon footprint. It's faster. Ethereum is actually moving from proof of work to proof of stake so that it can handle more than a couple dozen transactions a second to perhaps 100,000 transactions a second. So, so to do this, you can actually stake your Ether, you can stake Cardano, you can stake Polkadot, so on and so forth, and you can earn rewards there from like 8 to 10 to 12 to 15%, depending on the protocol you stake at. And it's important for listeners that might want to do this to understand that each protocol is different and that you really want to make sure you understand the terms and conditions, because some come with lockup periods. Like for instance, if you stake Ethereum, your Ethereum or your Ether is going to be staked for probably at least another year until the transaction is complete. That means you can't withdraw it, even if you need the money. If the price drops, it's locked there. That said, there are a bunch of exchanges like Kraken, Coinbase, Gemini, Binance for some that offer staking services that they themselves help provide some more flexibility for users, but they take a fee. But those are a couple of main ways that you can earn passive income on your investments without necessarily having to sell. And it's a great way to just stretch out gains when you can.
You know, with cryptocurrency being the new asset class in town relatively to other assets, you know, we at AAII, we preach diversification, and it's hard to know what I guess the appropriate allocation is of cryptocurrency is if you're trying to incorporate it into your investment portfolio. Are there common allocations or guidelines perhaps for holding cryptocurrency in your portfolio?
So this is probably the number one question I get asked all the time. And the answer, to disappoint you, is it's an individual decision. I mean, everyone has different levels of wealth, risk tolerance, and also depends on your age, your investment horizon, and so on and so forth. Typically, I tend to recommend that, although none of this is investment advice, I tend to recommend about 1 to 5% in your portfolio. I'm a little bit higher. Some people, especially on the younger generation, are a little bit higher. I mean, I saw a survey that I think like 50% of all millennial millionaires have 50% of their assets in crypto, which is probably why they're millennial millionaires to begin with. But crypto is a volatile asset, and some people they talk about it almost like a badge of honor, almost like being a failing startup founder, for instance. But at the same time, like it's not just a figure of speech; it is volatile, and there is a non-zero chance that it goes to zero. So make sure, like anything else, you don't invest money that you can't afford to lose. And my recommendation is to invest as early as you possibly can, because as you get closer to retirement, I mean, Bitcoin can lose 50% in a week. Like you may not be able to lose that money, but if you're in your 20s, your 30s, your 40s, you have time to make up those gains. So I guess my best advice is, like I said, make it a small part of your portfolio. Grow out over time. The best investment strategy I tend to recommend is through something called dollar cost averaging, where maybe you purchase like $100, $20, I mean, whatever you can afford at sort of set periods of time, so that over time, like your base is something manageable, and hopefully your assets can grow.
Finally, I do want to ask you maybe a basic question about actually buying cryptocurrency. You mentioned a few names before. Where should first-time crypto investors turn to, and are these platforms trustworthy? It's not like you can just walk into a traditional brokerage like TD Ameritrade and say, "Hey, I want 5 Bitcoins, please." That's just not how it works. So, if you could just mention a few that maybe people should take a look at.
Yeah, and this is a great point because it's actually getting easier to buy Bitcoin now than it had been in previous years. I mean, typically, especially over the last couple of years, the best place to go is to an exchange like I said, Coinbase, Kraken, Gemini, Binance US, Bittrex. I mean, those are some of the bigger ones in the US, and they've done a better job at creating very friendly user interfaces and making the sign-up process more streamlined, although there still can be some friction. And I know that some individuals are worried about tying their bank accounts to these groups or debit cards, and which is understandable as well. There are other ways, especially for newer investors that perhaps aren't interested in the dozens of tokens that these exchanges list, but maybe they're just interested in Bitcoin, Ethereum, and Litecoin, for instance. Square offers a pretty easy Bitcoin a Bitcoin brokerage service. PayPal now offers brokerage services in Bitcoin, Ethereum, Litecoin, and Bitcoin Cash, I believe. I mean, Robinhood offers, you can buy crypto through Robinhood, Revolut. So a lot of these newer brokerage platforms are letting you are making it simple to buy as well. And then there are other ways through more traditional securities to get exposure to the space. If people are not interested yet in actually owning crypto themselves and want to essentially deal with the security that comes with protecting it, because it is a bearer asset. You can buy stocks like Coinbase, trades under the ticker coin on NASDAQ, which offers broad exposure to the space. There's plenty of Bitcoin mining stocks out there that essentially act as almost Bitcoin ETF proxies until one gets approved, like Marathon and Riot are two big ones. For some more affluent investors, they can purchase shares in sort of closed-end funds, such as offered by Grayscale, the largest asset manager in the space. They offer dedicated funds on, I think, 10 to 15 major assets, as well as a diversified one. Bitwise is another company that offers some of those. So there are ways to get exposure to the space through traditional brokerage accounts if the individual investor is not interested in actually owning the crypto themselves at this point. Although if you take that approach, then some of those passive investment strategies won't necessarily be available to you.
Great. Well, thank you so much for the information, Steven. Where can people follow you and your work?
Great. So probably the best way to follow me is just on Twitter at Steven_Ehrlich. You can also reach out to me anytime at sehrlich@forbes.com. And if you really are interested in following my work, I'd recommend that people subscribe to our research service, Forbes Crypto Asset and Blockchain Advisor. And I think one of the reasons why, aside from the research that we put out on a regular basis, one of the things I think a lot of our subscribers appreciate is the fact that I'm always available to answer questions, hop on a phone call, have discussions about individual questions and choices that investors are trying to make. So those are the best ways to get in touch with me. And thanks so much for having me on the show.
Yeah. And while we're mentioning things that you've written, if you want to read more about this particular topic, you can check out Steven's article. It's called The Options for Investing in Cryptocurrency. It's in the July 2021 issue of the AAII Journal, both in print and on AAII.com. Thanks again, Steven.
Great. Thank you.
Today I'm joined by Derek, author of Stock MVPs Passing the Most Screens. Derek, happy to have you here.
Yeah, hey Kyler, it's great to be here. Thanks for having me.
Of course. Can you tell us some of the companies that pass the most screens, and are there any trends that the individual investor could look at?
Yeah, definitely. As you said, for this month's First Cut stocks, we looked at those companies passing the greatest number of AAII's screening strategies. And as of June 11th, 2021, there were only 18 stocks that passed 5 or more screens. And this is from more than 6,000 stocks that we track in Stock Investor Pro, which is AAII's fundamental stock screening and research database program. A few of the companies that passed multiple screens include Logitech International, which provides computer hardware, and Williams-Sonoma, which is an American retailer of cookware, appliances and home furnishings. They both passed 5 of our screening strategies. And then there was Petrobras, ticker PBR, which is a Brazilian oil and gas company. That company passed 6 of our screens. And there are some general trends that individual investors could look at. According to FactSet, analysts expect double-digit earnings growth for the remaining quarters of 2021. And these above average growth rates are due to a combination of higher earnings for 2021 and an easier comparison to unusually weak earnings in 2020, of course, due to the negative impact of the coronavirus pandemic on numerous industries. But this improving trend has driven estimate revisions upward for many of the hardest hit industries and companies most exposed to the coronavirus pandemic during 2020. So retailers, oil and gas, and restaurants, to name a few, they've enjoyed strong performance over the past few weeks, as well as upward revisions to earnings estimates from analysts. And these may be worth examining in a resurgent economy.
As noted in the article, Dick's Sporting Goods is trading at its 52-week high. Is this peak something investors can rely on to continue throughout the summer, or is this more of a short-term option?
Well, I wish I had a crystal ball to answer that question, but I think one thing that may help is if we look at some of the screens that Dick's Sporting Goods passed as of June 11th. At that time, it passed 10 of the 60 AAII screening strategies, including the Buffett-Hagstrom screen, which looks at factors such as value, growth, and quality. It also passed the Draymond with estimate revision strategy. Of course, that strategy utilizes value and growth for contrarian stocks with upward revisions. It also passed the Kirkpatrick growth and Kirkpatrick value screens that look at value, growth, and momentum, and estimate revisions up 5% screen, just to name a few. But there are a few takeaways from the estimate revisions up 5% screen, which Dick's Sporting Goods passed. Since both positive and negative earnings surprises have lingering long-term effects, tracking these revisions is definitely a rewarding investment strategy. And expectations, they play a key role in determining if a stock's price gains or loses when actual earnings are reported. And investors quickly learn that the market is forward-looking, and security prices, they're established through expectations, and prices change as these expectations change or are proven incorrect. So changes in stock prices resulting from earnings surprises, they can be felt immediately, and the surprises have a long-term effect. So studies indicate that the effect can persist for as long as a year after the announcement. And this means that it does not make sense to buy a stock after the initial price decline or a negative earnings surprise. There is a good chance that the stock will continue to underperform the market for some time. It also indicates that it may not be too late to buy into an attractive company after a better than expected earnings report is released. So firms with a significant quarterly earnings surprise, they also often have earnings surprises in subsequent quarters. And when a firm has a surprise, it often is a sign that other similar surprises will follow. Just want to say one more thing about that. Since both positive and negative earnings surprises have lingering long-term effects, a rewarding investment strategy is one that avoids stocks you believe will have negative earnings surprises or that have had negative earnings surprises. Selecting positive earnings surprise stocks before and even after the earnings come in may be similarly profitable. So revisions made by analysts to earnings estimate lead to price adjustments similar to earnings surprises. And when earnings estimates are revised significantly upward 5% or more, stocks tend to show above average performance. So stock prices of firms with downward revisions show below average performance after the adjustment. Changes in estimates reflect changes in expectations of future performance, and perhaps the economic outlook is better than previously expected, or maybe a new product is selling better than anticipated. And we'll definitely have to see how this plays out for Dick's Sporting Goods.
Of the many screens that a stock could potentially pass, are there some that are worth more than others, like the don't lose money screen, or are their values dependent on what the individual investor is looking for?
Well, AAII's stock screens, they really run the full spectrum, from those that are value-based to those that are focused primarily on growth. Some AAII stock screens are geared toward large company stocks, while others uncover micro-sized firms. But most fall somewhere in the middle. And there are even a number of specialty screens that attempt to gauge the stock selection impact of a single variable, such as the earnings estimate revisions, like we just talked about with the estimate revisions up 5% for Dick's Sporting Goods. Needless to say, that the characteristics of these stock investment approaches, they definitely vary widely. And it is important to understand the investment characteristics of any approach you are using. And by browsing through the passing companies tab of a stock screen, you can get a better idea of the kind of companies that a strategy favors, along with a sense of any industry concentrations that may be generated. And the purpose of AAII's stock screens is to provide you with access to a wide range of investment approaches. And in terms of any judgment concerning which screen appears to work best, it is recommended that you look at the long-term returns as well as recent performance. And understand that the screen portfolios presented, they are merely computer-generated lists based on AAII's interpretation of popular investment approaches. The criteria or rules used to generate the list of passing companies are presented for each screen. But with that being said, the screen tracking results are quite revealing. If you want to examine the numbers, complete performance statistics, including year-by-year figures, are presented in the stock screens performance table. And this can be accessed from the screening drop-down menu from our website, AAII.com. There are a few things, when determining which screens you want to follow, it helps to ask yourself the following questions. How is your screen of interest reacting relative to the current market environment? If it is deviating substantially, what is the cause of that deviation? Is it the individual stock picks, or is it a deliberate over-concentration caused by the screen's investment methodology? Another question to ask yourself is, are the screen's characteristics more similar to a value-based or growth-based approach? And any screening approach that you follow should match your individual needs and risk tolerance. Most importantly, though, remember that screening is just a first step. There are qualitative elements that cannot be captured effectively by the very quantitative screening process that we present. Detailed fundamental analysis of any stock you are considering for purchase is necessary for successful investing. But Kyler, I would like to end with this comment. I think it is a good question to ask. Is a stock that passes multiple screening approaches more attractive than another stock that just passes perhaps one screening approach? I think the answer is potentially. And potentially, if the screening approach a stock passes are based upon solid financial principles and are diverse enough to capture unique yet desirable qualities.
Thank you so much. If you would like to learn more about this first cut stocks list, check out Derek's article in the July 2021 AAII journal titled Stock MVPs Passing the Most Screens. It's available on AAII.com and in the print edition. Thank you, Derek.
Thanks, Skylar.
Today, I'm joined by John Buckowski, author of Rules Change and a New Stock for the Model Shadow Stock Portfolio. John, how are you doing today?
I'm doing great. Pleasure to be here.
That's great. Well, John, it is no surprise that this year the Model Shadow Stock Portfolio is starting off with a resounding success. 14 straight months of positive gains and 5 coming from this year are nothing to scoff at. With this kind of success, it is easy to get lost in this excitement. In your history of working on the Model Shadow Stock Portfolio, have you ever seen this level of success? And if so, how long did it last?
Well, what we've found in general is that the performance of small cap stocks relative to large cap stocks tend to be kind of streaky. We just went through a 4-year period of underperformance, and it's in the industry they call it serial correlation. But it's small cap stocks have this one tendency that when things go well, they tend to do well for a period of time, and when things go poorly, they kind of flail for a little while. Over the 28.5 years we've been around as a model portfolio, we've outperformed the market any individual time period only 17 years out of those 29, so roughly 60%. So 6 out of 10 years has been the outperformance on any given year. But with that greater volatility comes the possibility for greater long-term rates of return. So the rate of return for the model portfolio has been strong, but we have had these kinds of streaks where for 3-4 years they'll outperform and then they'll underperform for a couple of years.
And why was this decision made to increase the price, the book cutoff for the lowest decile from 1 to 1.1 at the beginning of June? Will there ever be a reason to bring that cutoff back down, or increase it again?
Yeah, definitely. We review that. The goal of the portfolio or the strategy is to invest in the stocks that make up the lowest 10% of market cap as measured on the NYSE, and the lowest 10% of all stocks when it comes to price to book. So on a regular basis, whenever we do a quarterly review, is we take a look at what is the current breakdown on the market cap of the NYSE stocks. We then take that level. In this case, we saw the increase of the market cap for the overall NYSE stocks. The market cap go from 370 back in end of March to 470 in June. And we'll take that market cap level and then apply it to all publicly traded stocks and see which stocks meet the other financial criteria. So yes, over the years, the market cap level has changed, as well as the price to book. And if the market gets cheaper, or if there's an influx of more stocks trading with lower price to books, or market cap goes down, we'll definitely make that change, so that we're always looking at that one quadrant of cheap, low-priced small company stocks.
Once a stock has been removed from the model shadow stock portfolio, like CPI, Aerostructures, and Hallador Energy Company, is there any possibility of that stock being added back into the portfolio in the future?
There is. I mean, a lot of it depends on why a security was removed. In some cases, stocks grow to be too large, and often they continue to be successful, and we don't ever see them again in a micro cap portfolio. Occasionally, stocks are also removed because they have negative earnings. And in that context, if we wait 2 years, we don't want stocks to kind of become kind of coming on and off the list perpetually without actually going up in stock price. So we'll wait 2 years, and we have all these rules spelled out on our website. So if you go to the model portfolios section of AAI.com, we have all these rules spelled out, but we'll wait 2 years before we consider buying it again, should it pass the initial criteria. So should it be in the lowest 10% as far as price to book, the lowest 10% as far as market cap, have positive earnings, have positive expected earnings if those are available, have a price to sales ratio of less than 1.5. So if those factors are okay and still good, and it's been more than 2 years since we've held it, we would consider adding it to the portfolio again.
And last, when looking at stocks, it is important to ignore the context of the world around us. And right now, our world is COVID. With the vaccine distribution rolling out across the country and around the world, how much an effect did the reality of global trade opening up have on the decision to add Pangea Logistics Solutions Ltd., a transportation company, to the portfolio? Do world events often have an effect on stocks added or removed from the portfolio?
That's a great question. I mean, they have an effect, but we don't actively try to take advantage of it. The shadow stock portfolio is what you really call a bottom-up approach to investing, where you have certain rules you apply to individual stocks, and those stocks probably are made available or made interesting because of world events. They may all of a sudden be profitable and their price to book is attractive, or they may have increase in momentum because of perceived investor interest in those securities. So with a bottom-up approach, world events have an impact on the securities you're adding to the portfolio, but you're not actively looking at that. It's a very quantitative approach. In contrast, a top-down approach would have you specifically looking at market events, such as the lifting of COVID restrictions and their impact. And because of that, you then seek out stocks specifically that would beat that particular factor. We don't do that. It just kind of happens more on in a real-world context. So last quarter, when we sold something like RCI Hospitality Holdings, it had done so well because of reopening, and all of a sudden people were able to go to its facilities. So it became a very large cap stock and became too expensive. So we don't actively seek them out based upon world events, but world events have an impact on every stock that in effect is traded. So it impacts it, but not in a active way that we look at it.
Well, thank you for your time, John. Happy to have you here. If you'd like to learn more about the model shadow stock portfolio and the new stock added, check out John's article in the July 2021 AAII journal titled Rule Changes and a New Stock for the Model Shadow Stock Portfolio. It is available on AAII.com and in the print edition. Thank you once again, John.
Oh, it's been a pleasure. Take care.
Thank you. Okay, perfect. Thank you so much.
Yeah.
And now for our listener mailbag segment, where we address questions that have been submitted by viewers and AAII members and answer them here. If you have a question for us, you can submit them using the questions panel in your GoToWebinar control panel, or you can email Kyler at kwurf@aaii.com with the subject line II show question. That's kwurf@aaii.com. All right, Charles, this question came in and we wanted to have you answer it. This question comes in from Pablo Catalan. He asks about stock splits, which we talked about last time on the show. He says, I would appreciate your comment when the stock's operation is a contra split. Let's say, as an example, 10-1. How should I think about that case and about the corporation taking that reduction of shares in that marketplace? Is the conclusion positive or negative?
Sure. So to step back and just so everyone understands, so a stock split is when a company takes its share and it divides it. So say the stock's trading at $200 per share, a company announces a 4-to-1 split. Instead of having one share valued at $200, you now have 4 shares valued at $50. So essentially, in this case, the stock split reduces the share price, but also increases the number of shares outstanding, thereby making the stock more affordable. And the goal is that hopefully the company will attract more investors who prefer stocks trading at a lower quoted price. A contra split, or really a reverse split, is the exact opposite. So in this case, say the stock's trading at $5 and the company wants the stock to trade at $50. In this case, they would actually reverse the split. So instead of having 10 shares, an investor would now have 1 share. So they would start off with 10 shares priced at $5 each. Those would be swapped out for 1 share valued at $50. So same total value, but it's reduced. And the reason why companies do that, if the stock price gets too low, a company does run the risk of being delisted from either the New York Stock Exchange or the NASDAQ. It also sends a signal to investors that the stock price is higher that the company is stronger. So when the stocks are trading, say, low single digits or mid single digits, say $6, $5, it might suggest that investors don't view the company as being particularly attractive, or perhaps there's some issues with the company. Now, again, as always with investing, there is a difference between the share price and the underlying fundamental value of the company and the underlying business strength. But companies do reverse split to boost their prices. And the danger with reverse splits is not so much the reverse split itself, but why is the company doing it? Why is the company's price so low, particularly if the price has dropped significantly? Has there been an issue with the business? Perhaps it's just business conditions really deteriorated for factors beyond the company's control, or perhaps there was bad management. So whenever you have a reverse split, it's very important that you stop and look at the situation at hand and ask yourself, is there anything fundamentally changing with the company that's now making it more attractive? Is the company perhaps on the rebound? Has there been a positive shift in business strategy? Or was it a temporary event? Say it was a restaurant that was hit hard by the coronavirus, and now the economy is reopening, business is actually going to rebound, and the company was able to get through the period without having to dilute its shareholders. So a reverse split isn't necessarily a bad thing, but you always want to look at the causes as to what led to that decision to do the reverse split. And were those events temporary, or were there risk at hand that might still exist now?
Well, thanks again to our listeners for those kinds of questions. Again, if you have a question for us, you can submit them using the questions panel in your GoToWebinar control panel, or you can email Kyler. His email is kwurf@aaii.com with the subject line "II Show Question." We'll get them on air for the next episode. Thanks again, Charles.
Thank you, Ryan.
And now a word from our friends at Discover Bank, sponsor of the Individual Investor Show and AAII webinars. We know as individuals interested in building investor wealth, you never want your money to be idle. Even small dollar amounts for short amounts of time should be working for you. With that, we're pleased to share information from our partner, Discover Bank, on deposit accounts that keep your money moving. You can choose from several options to help you meet your short-term or long-term financial goals. The best part? All of the deposit accounts offer preferred member rates. Please take a look. If you liked our show, please visit aaii.com/webinars to register for more webinar and video content. Like us on Facebook and follow us on Twitter at @AAII_invest_ED. For more investing education, check out our website, aaii.com. I want to thank our guests, Steven Ehrlich, Derek Hageman, John Buckowski, and Charles Rupplet. And of course, you for listening. We'll see you next time.